Good morning, friends. Welcome to this wonderful seminar on this Saturday morning, and it's nice that we're starting on time. The profile of the speaker is already in your hands. You must have gone through it, and by his deliberation, you will come to know more about him. Just to start, do the rituals. May I request our member Sivji to kindly come up and present a flower bouquet to Mr. Khushbroo Panthaky, and welcome him to EIRC this morning. We'll straight start the deliberation. May I request the speaker to kindly take up this.
Very good morning to all of you, friends, and this has been the fastest transition from the initial speech to the speaker. So I really appreciate, and I think my apologies for sort of disturbing this program a little bit, because as Rungtaji mentioned that I have to travel, and there's only one flight which goes to Ahmedabad, and if I miss that flight, then there are 350 people out there who will be completely stranded. So my apologies for this, but I can assure you that over the next 1 hour 45 minutes, I would try and cover as much as possible. There is a lot in my plate today in terms of the agenda to be covered, but I'll make sure that whatever is important, I would definitely cover. In addition to what is required to be covered by me, a couple of requests have come in this morning to cover a little bit on fraud reporting, a little bit on ICFR. So I just thought that before I deep dive into the presentation, normally I would like to make an overview kind of a speech, but I believe still people are yet to come in. Being a Saturday morning, it's definitely not the right time to start a technical session at 9:30. So definitely by the time they come in, I will get into the more technical aspects of it. But I think before they get in, just one request came for fraud reporting. I would just like to highlight the recent guidance note which has come on fraud reporting, friends. As you all are aware, it is not the duty of an auditor to sit down and audit in such a way that the frauds are detected. That's not the duty of the auditor. The auditor has to carry out his duties in a manner where a true and fair view on the state of affairs and the results of operations can be assured to the stakeholders, to the shareholders. However, the procedures to be carried out by the auditor as a part of the normal audit procedures should be adequate and should be cumbersome. That in the event that there are any indicators triggering fraud, then those indicators can be captured. More work can be done to see if at all there are any risk factors which could result into frauds. But the auditor is not sitting out there to detect the fraud. Now there is a guidance note which came out, and there is again, as I have covered this also earlier when I was in Calcutta, speaking about 6 months ago, that the responsibility of reporting the frauds is now lying upon or casted upon the auditor. But there is one clarification which has come up pretty well in the guidance note, and that clarification says very clearly that during the course of his duties, if the auditor believes that there are enough evidences and enough conditions which could trigger into a fraud, then it is his responsibility to inform the audit committee chairman. In case if the company does not have an audit committee in place, then it is the responsibility of the auditor to report it straight to the directors. Having said this, of course, automatically he would inform the CFO and the CEO and the managing director. So if he comes across an instance where he believes that there could be a potential fraud, or there are enough evidences to substantiate that this could be a fraud, he needs to highlight it. Then that particular matter sits with the audit committee or with the board of directors. They are required to carry out an investigation, determine the extent of the damage caused by the fraud. Having done that, they need to sort of initiate appropriate action against individuals who are responsible in that fraud. And they need to come back to the auditor within a period of 45 days after the auditor has communicated to them. So let's say if I communicate to them on the 1st of January, then in that case by the 14th of February, the audit committee or the board is required to come back to the auditor. And then the auditor will have 15 more days to report that fraud to the central government in a particular form called ADT4. And that statement is called ADT4, in which he is required to report. And that is something which is now the law of the land. But there are other circumstances also. And what are those circumstances? Those are, normally if the fraud has been detected by the company, by the management, then the auditor does not have a responsibility to report that fraud to the government. Then there is its own process whereby they will investigate the fraud and they will sort of determine the extent of the damage, take appropriate action, and provide necessary adjustments in the financial statements. So the auditor should be completely aware about the frauds, even if at all he has not discovered the fraud. And therefore, in the event that he has not discovered the fraud, it is his duty to ensure that whether those are properly adjusted, given effect to in the books of account, and what has been the appropriate action. At the same time, frauds on the company by the officers and the employees, and frauds by the company also need to be reported and continue to need to be reported under CARO as well. So this is something that I thought that, from a fraud reporting perspective, most important clarity is that only report those frauds to the central government which are required to be done based upon your own findings and not the findings of the management. So this is one aspect. The second request that came to me was in relation to internal controls over financial reporting. It's not forming part of the agenda today, but before the hall is filled up, I just thought that I can spend a couple of minutes on these things. All of you are aware of the fact that this is a new requirement under the Companies Act. It is something very similar to what we have internationally called the Sarbanes-Oxley. The difference is that Sarbanes-Oxley is applicable to the listed companies internationally, in the United States, and the subsidiaries or the larger subsidiaries of these companies in the United States, which are listed companies. Unfortunately, SOX or the replica of SOX in India is applicable to all companies. So ICFR, Internal Control over Financial Reporting, is now applicable to all the companies in India, except there are a few exceptions. Having said that, for the year 31st March 2015, that is this year which we are going to sign off as auditors, and where you have a responsibility being a part of the management or being a part of the board. In the case of unlisted companies, currently, in the case of listed companies, the entire internal control over financial reporting, the entire platform needs to be there. The process owners need to take the responsibility of signing off on the internal controls underlying the processes. The CFO and the CEO certification has to be placed at the audit committee, and the audit committee chair needs to give that comfort to the board, and the responsibility of the board is to adopt that particular risk management structure to say that there are adequate controls over financial reporting. This is a requirement for 31st March 2015 for listed companies completely. However, in the case of unlisted companies, as long as they are ensuring that there are adequate procedures or there are adequate controls in relation to the development and the design, it's fine. So adequacy of design of controls is the prime responsibility of the management for 31st March 2015 year end. In both the cases, in the case of listed companies and in the case of unlisted companies, the auditors are not required to do anything at this point of time. But for 31st March 2016 year end, which is the current year 2015-16, it is also the additional responsibility of the auditors to attest the internal control over financial reporting, which is primarily the responsibility of the management. So in addition to the fact that the auditor will be signing off the financial statements and giving a true and fair view as he would normally do, he will also be required to provide an attestation on the ICFR at the same time, on the same day. But friends, most important thing over here would be, I would like to remind you of the fact that the audit is basically a post-mortem which happens in the months of April, May, June, July, August, September. ICFR has to be done online. You need to evaluate the design of controls and the operating effectiveness of controls during the year 2015-16 and complete your process before 31st March 16. Else you will not be in a position to comment on the controls which could be live. You are not required to do any post-mortem work at that point of time there. So whatever work you will be required to do on your clients, which are your audit clients, listed companies and unlisted companies, please do it throughout the year. In fact, we as a firm have started the process in some of our larger clients where we believe that there is a requirement to sign off on the ICFR as well. So I think this is an important thing. Another heads up for my professional colleagues that this is an additional effort, an additional risk and an additional deliverable. And therefore the fees can be from any number to any number. Based upon my discussion with my peers and within my own firm, I believe that the efforts can be anywhere between 40% and 100% of the audit efforts, at least in the first year. and therefore please make sure that this is additionally billed to your clients, because this is an extra attestation, an extra risk, and an extra deliverable that you will be delivering to your clients. So this is again one more point that I wanted to emphasize upon where ICFR is concerned. Now, since I believe that we have a good number of people over here, let me sort of very quickly take you through some of the important specific matters. I would kindly request you to park your questions with you, because I have to finish this in the next around 90 minutes to 100 minutes, and therefore I would appreciate if you could park your questions to the end. I will make an attempt to answer most of your questions and make sure that you are completely satisfied with the responses. Now, coming straight to the main topic today, I have to cover the auditing standards, I have to cover the new reporting audit format, I have to cover consolidation of financial statements, some of the circulars that have come in, what needs to be consolidated, what does not need to be consolidated. Let me just quickly touch upon some of the important slides. Now, these presentations have been made by me in the past. They are very exhaustive. Some of the slides are quite repetitive in nature, and therefore I think I would be skipping some of the slides, so don't worry. Whatever is required to be delivered, whatever is required to be understood, I will make sure that it is completely understood by you. Now, these are the new standards of audit. I remember earlier there was a standard called AAS 28, which was Auditor's Report on Financial Statements, a very simple standard of 4 or 5 pages. But having sort of, been through that particular phase, and since the standards of the institute are now aligned to the international audit standards, it is time now that we also raise the bar and get into the details of this. Just as a matter of 1 minute heads up. Today, as you all are aware, the profession of auditing is becoming more and more difficult. Expectations are becoming higher and higher. Penalties are rising on the management and on the auditors in case if something goes wrong. But at the same time, the auditors are not completely aware about the real repercussions that can happen on the firm and on the individual. The constitution of the National Financial Reporting Authority itself would mean that in case if something goes wrong, they will have all the powers to punish the auditor. It could be a simple fine, it could be an imprisonment, and if at all the auditor is involved in a particular fraud along with the client, that can be an imprisonment up to 10 years. And with a fine which can be triple the size of the fraud, which is something very unthinkable of. So it is time now that if at all we have audit clients, we need to serve our audit clients very well with the right kind of people, with the right kind of audit tools, with the right kind of training that we need to give our people, and to completely follow the auditing standards. World over, it is known very clearly that people have a passion and people have a liking on the accounting standards or for the accounting standards. But with due respect, the emphasis of individual professionals and many of us is very, very low on the auditing standards, and that is the reason why ICAI has been emphasizing on the auditing standards over the last few years much more rigorously than what they were doing in the past, because the profession is becoming difficult, and if at all we don't follow the standards well, then I think we are causing trouble for ourselves. So that's the reason why I always say that, please make sure that if at all we are in the audit profession, we need to do our job well, we need to ask the right fee to our clients, and we need to make sure that we have the right people on the job and pay those people also well so that they do the job pretty well. Now 700, 705, 706, 720, they all talk about auditor's report. Auditor's report can be a clean report, like an unmodified report. It can be a modified report. And within that modification also, there could be 3 types. It could be a disclaimer of opinion, it could be a qualification, or it could be an adverse opinion. However, in the past, we have seen many financial statements having an audit report where a particular para has been emphasized by the auditor. Now, I remember inconsistent practices a few years ago where the auditors used to invite attention on a particular note even without understanding exactly as to what is the need to emphasize. Or even where there is a need to emphasize, he would not emphasize. There can be a case where it is a pure qualification, but he would not want to give the qualification, so he will emphasize. And there is a case where something need not be qualified, and he would have qualified. So all these standards are actually going to provide a lot of clarity in the next, they have been in existence for the last 2-3 years, but a lot of emphasis was not given on that, and therefore these need to be completely understandable in terms of appropriate interpretation and application as well. So 700 talks about Forming an opinion on the financial statements, as I mentioned, it was a part of AAS 28 earlier. It is to form an opinion, and this particular standard deals with the form and content of the auditor's report on general purpose financial statements. General purpose financial statements are basically financial statements which are available to the public at large. It also promotes consistency in the auditor's report, because worldwide the auditor's report has a consistent format. And even in India, anybody and everybody cannot write the way they would want to. There is a particular format, and therefore this format has to be sort of followed, which will provide consistency in the reporting. It also promotes the understanding of the users in terms of what exactly has been reported, and will also identify unusual circumstances in the event that the profits have been overstated or understated, or if at all there is any adverse remark. Then the auditor's report have a requirement to disclose that particular matter. So it also provides that information. And this standard, as you would be aware, is applicable from 1st April 2012. So we have already finished 3 years of this particular standard being in place. As I said, some of the slides are only repetitive, so I would just like to sort of skip those. Now, what are those general purpose financial statements? They are meant for the users at large. They are meant for anybody and everybody. They are open. They are there on the internet. And therefore, there is a major use or a significant larger use of those financial statements. However, there is something called a general purpose framework as well, which is very aligned to the general purpose financial statements, which says that the framework is designed to meet the common financial information needs of a wide variety of users, which is basically our Schedule 3 of the Companies Act. And therefore, in case if at all there is a purpose for the financial statements, there is a framework for the financial statements, and therefore that's called as general purpose framework as well. Unmodified opinion, which is going to be the 700 standard, is an opinion which is a clean opinion without any specific qualifications or any adverse remark. What is an opinion? My opinion is on whether the financial statements are prepared in all material respects in compliance with the applicable financial reporting framework, which means that are your financial statements giving a true and fair view on the state of affairs of the company and on the financial position of the company? However, the auditor also has to ensure that he has reasonable assurance. You can never have a 100% perfect audit. You can never get a 100% assurance. You will always have a reasonable assurance. So, and therefore, it says that whether you have a reasonable assurance as to whether the financial statements that you are auditing are free from material misstatement. Now, materiality is something that you determine based upon the auditing standards at the time of planning and at the time of reporting. Now, what is this materiality? Below a particular threshold, you may completely ignore the adjustments. A little above a particular threshold, but below the overall threshold of materiality, you will still not pass the adjustments in the financial statements, or would not require to pass these adjustments in the financial statements, but you will collate on a separate sheet all those adjustments which have not been adjusted, or all these items which have not been adjusted, and you will take a net impact of that. And if the net impact ultimately is beyond the materiality threshold, then you will get the entries passed. And therefore, an auditor can live with by not passing certain adjustments in case if he believes that the net impact of those adjustments is below the materiality. And that is the reason why it is important to mention in the audit report that they are free from material misstatements, because there will be always a few misstatements here and there, but the net impact of that would not be very material. The auditor is also required to ensure that he has obtained sufficient appropriate audit evidence. Look at it. It says sufficient in terms of adequacy and appropriateness in terms of having the relevant evidence to give an opinion. His conclusion also is to make sure that whether uncorrected misstatements are material individually or in aggregate. This is what I touched upon, that all those items which have not gone through in the financial statements, either individually or collectively, are they beyond a particular threshold? If they are beyond, then you need to pass the adjustments. The financial statements are also required to disclose the accounting policies, which is forming part of my notes to accounts, because without reading the accounting policies, the reader of the financial statements will never understand what kind of accounting principles and what kind of policies have been adopted by the company. And these can vary from company to company, from industry to industry, and for the purposes for which the financial statements are prepared. They should be also consistent. We know that the policies have to be consistent. with the applicable financial reporting framework. Now, my accounting policies are aligned to the accounting standards issued by the ICAI and notified under the Companies Act. Currently, we are following Indian GAAP, which is basically the Indian accounting standards, and not the Ind AS, which are going to be applicable from 1st April 2016. And the accounting estimates made by the management, are they reasonable? Now, the accounting estimates like depreciation, like loading of overheads on the inventory, like retirement benefits, like estimation in terms of provision towards contingent liabilities, these are all the estimates made by the management. It doesn't mean that the auditor does not have any duty towards it. The duty of the auditor is to ensure that whether they are reasonable, whether they are in line with the fair practices, and whether they are conservatively determined to ensure that when accounted in the financial statements will be providing a true and fair view. Also, the auditor has to ensure that whether the information given in the financial statements is relevant, which is required, reliable, can be trusted upon, comparable with the earlier year, and understandable, which means that you should not leave it to the determination of others. It should be clearly understood. And therefore, any adequate disclosures which are required under the statute need to be given. In addition to that, the framework also says very clearly that in the event that for a best practice and to ensure a little higher transparency or a better transparency, if you would like to give something voluntarily on your own, then you can do that as well, because that will be appreciated as a relevant disclosure and a best practice disclosure. This lady is quite thrilled on account of the fact that an unmodified opinion has been provided on the financial statements. Everybody is thrilled when a clean opinion is given, including the auditor. Even the auditor would not be happy of giving an opinion which is a modified opinion, which could be a qualified opinion or a disclaimer. Internationally, if you look at the reports, 99.9% the opinion that is given is an unmodified opinion. What does it speak of? It speaks of the fact that the auditor was in the best position to make the client understand about the implications of a qualified opinion. A qualified opinion is never seen as a good opinion because of the fact that the company has not made an adjustment that it requires to be made. And that adjustment may not have been made for whatever reason. They would want to show the profits higher, they would want to show the expenses on the lower side or whatever. But if it is there in the audit report, the world at large knows about it. So there is nothing to be scared of. And therefore, unmodified opinion is always the best opinion on the financial statements. Coming to the modified opinion, what I call as an opinion which is not a clean opinion. When does this auditor would give a qualified opinion or a modified opinion? And see, even I am using this particular terminology very synonymously, which is wrong. The word is not qualified, it says modified opinion. And qualified opinion is one part of the modified opinion, or is one aspect of the modified opinion. Now, whenever the auditor concludes based on the audit evidence, look at it, it says audit evidence, appropriateness of the audit evidence, it says every time. Based on the audit evidence obtained, if the auditor believes that the financial statements are not free from material misstatement, which means that he has something to say, that there is an adjustment which is to go through and has not gone through in the financial statements, then the auditor would give an opinion which is a modified opinion. However, at the same time, even if he does not have enough evidence or is unable to obtain sufficient appropriate evidence, and if at all he has a reason to believe, to conclude that if he has not got this particular information, the financial statements are not free from material misstatement. Which means that one is you have the evidence and you believe that financial statements are not free from material misstatements. Other is when you do not have the evidence and based upon some other procedures that you have carried out, it is believed that the financial statements are not free from material misstatement. Even at that point of time, you would be giving a modified opinion. So now when you come to the modified opinion, it talks about the provisions of 705 and therefore it says very clear, we'll come to that later. If the financial statements do not achieve fair presentation, that means that the presentation in the financial statements in terms of disclosures, in terms of accounting policies, etc., If the financial statements are not providing a fair presentation, then the matter needs to be discussed with the management and those charged with governance to determine the need for a modified opinion. An auditor cannot just go and qualify whatever he would want to. The moment that there is an issue, it needs to be discussed with the management, it needs to be addressed. If the management agrees, great. If the management does not agree, it needs to go to the audit committee, it needs to go to the board, and then based upon the decision taken with the audit committee, the auditor will be in a position to give a modified opinion. Now, what is my audit report? My audit report is a report which is basically my responsibility, my document, my record. The financial statements are the responsibility of the management, and therefore the management's prerogative is to ensure that financial statements are providing a true and fair view where the auditor will give an opinion. But the report of the auditor is his own product, and therefore please be very careful when you draft the report. I have seen when we have actually accepted new clients, I have seen that there are mistakes in the report, there are apparent errors in the report, there is a grammatical error in the report, there is a punctuation error in the report, and in one case, in fact, not to sort of criticize, but I do not know whether it was a printing mistake or it was in one of the annual reports of a non-listed company. I was very happy to see that the auditor's report is signed jointly by the auditor and by the board of directors. So this was actually, I'm sure it must have been a mistake in the printing, but somebody should be observing these things, because this is something which is completely unbelievable. So the audit report has to be in writing, it cannot be an oral document. It clearly has to have a title of having been called as an audit report. It should be addressed to the people who are the stakeholders or the shareholders of the company. It needs to identify the entity whose financial statements have been audited. You have to have the name of the company. Every particular financial statement also need to be named. Now these are quite basic things, and therefore I don't think we need to dwell more on it. And of course it should have a list of accounting policies and other explanatory information. As much of information as you can give in the notes to accounts, to the extent relevant and reliable, is welcome. Beyond that, do not give information which is really not relevant and reliable. And of course you need to specify the date covered by the financial statements, balance sheet as of a particular date, and other things as of for the period. Now, responsibility of the management. In short, the management responsibility is to ensure that the financial statements are properly prepared, the books of account are properly maintained, the journal entries have been properly adjusted in the financial statements, the financial statements are drawn in accordance with the requirements of the Companies Act, now revised Companies Act 2013 under Schedule 3. It requires to report everything that is required to be reported. And if the management believes that there are certain notes that are required to be presented to give a better understanding of a particular matter or to provide more clarity and information, then in that case those notes have to be there in the financial statements as well. So that is the responsibility of the management. There is a complete section on the responsibility of the management in the auditor's report, along with a separate heading called management responsibility. Coming to the responsibility of the auditors, again there is a separate section, because see, an auditor's report is not only read by chartered accountants and bankers, it is read by an investor, it is read by different people, and those people may not be completely aware about the standards of auditing, and therefore it is important that it should be a clearly understood or clearly understandable document. So what is the auditor's report responsibility? It has to say very clearly that the responsibility is to express an opinion on the financial statements based on the audit that he has carried out. The audit has been conducted in accordance with the standards of auditing as issued by the Institute of Chartered Accountants of India. Under Companies Act 1956, the auditing standards were not notified. Under Companies Act 2013, the auditing standards are notified now under the Companies Act. And that the auditor has complied with the ethical requirements, and the auditor has planned and performed the procedures to obtain reasonable assurance. So auditor is even giving a disclosure about what he has done to provide an opinion on the financial statements. That he planned the audit, he performed procedures to obtain reasonable assurance, to get that comfort that the financial statements are free from material misstatement. Now again, in the auditor's report, there are certain specific disclosures that are required. And of course, before that, let me just touch upon three important aspects of audit which is basically planning, execution, and reporting or concluding. Internationally, you would see that planning is being given a lot of thrust. Unfortunately, in India, and this is again I'm saying more from the experience as well of having worked internationally and having worked in India in the past, that the planning is not given adequate thrust in the audit. Friends, before you go and start the work for an audit anywhere, please make sure that you understand the company, you understand the nature of the business, you understand the specific industry-related risks and audit-related risks. Accordingly, you would be able to appreciate which would be the areas of audit emphasis, which are the areas in a given company where you need to do more work or where you need to do less work. At the same time, you would know exactly where, under which processes, what are the controls that need to be examined. You need to carry out an internal control environment testing. It is definitely coming for next year, but even otherwise, without doing an internal control evaluation, you would not be in the best position to provide an opinion on the financial statements. So a lot of work is done on the planning front. Internationally, I've seen that the firms spend 25% to 40% of the total audit time in planning the audit. Then comes around 35-40% of the time in executing the audit, because a good planned audit means that you can complete the execution much faster. And you will be able to design appropriate procedures, relevant procedures, and so-called stringent procedures if you have done your planning well, because during the course of the planning, you have identified the risks which are affiliated to the financial statements. And therefore, once you do a good planning, you go do a good execution, you finally come to the reporting stage where you need to close and finalize the audit, discuss the issues with the CFO and the MD, bring out the issues to the audit committee and to the management if required to, and report accordingly. Under the new standards, you are required to meet the audit. In case of a listed company, the auditors are mandatorily required to have an executive session with the independent directors and the audit committee. What is the reason for that? The reason for that is to ensure that is there any kind of a stoppage, or is there any kind of a disturbance, or is there any kind of a interference in our audit process? Have the financial statements been given to us on time? Are there any major issues which have not been brought out in the course of the audit? Is the cooperation good? Is there any problem with the fee factor? Are you able to recover your costs? So these are the things that have been discussed in the executive session. And in case if at all there are any indicators to the auditor where he believes that there could be a potential fraud sitting, he may not have very clearly shared with the management. He is required to do that. But then it gives him an opportunity of saying that there are weaknesses in a particular process, and that particular weakness could result into a fraud at a later point of time. So these things are required to be discussed with the audit committee people, and therefore the conclusion part of the audit is also very, very important. Just one more thing, while giving an audit, if you would have seen in the audit report, it says very clearly, the auditor's responsibility is not to comment on the internal control underlying the financial statements. He is just required to ensure whether internal controls currently are commensurate with the size of the company and the nature of the business for the purchase of fixed assets, for the sale of goods and services, and for the purchase of goods and services. So currently under CARO, this is confined only to these three elements. However, going further in the next year, when we are doing an attestation of internal control over financial reporting, the responsibility of the auditors would be much, much more than currently compared to. Now, while giving an audit report, you need to have a heading called the opinion. So when I'm giving an audit opinion in the audit report, the heading should be there as an opinion. While you're giving an unmodified opinion, which means a clean opinion, you are saying very clearly that the financial statements present fairly in all material respects in accordance with the applicable reporting framework, and they give a true and fair view of the state of affairs and the result of operations. Now, we also have something called CARO, and I will touch upon it later during the course of my presentation. But if you look at the audit report, internationally the audit report is half a page or 1 page. In India also, the audit report is actually a couple of pages. It runs into a couple of pages if you follow this particular format. But at the same time, there are some specific elements to be covered in the audit report now. and even earlier as well. And we always have this annexure called CARO, which was there from 1988, which was called Mao CARO in 1988, became CARO in 2003, and became again a modified CARO in 2015. But that cannot be forming part of your audit report. It needs to be reported separately, and that is why you have an annexure. And you also report that particular annexure under a separate para, which is coming after the opinion. So anything that is an annexure or any other information that the auditor would want to give in the audit report will follow, will be subsequent to the paragraph on the opinion. And that is what this particular standard says very clearly, that there is a paragraph called report on other legal and regulatory requirements, and that shall follow the report on the financial statements. Now all over the world, as I said, that audit report can be only 1 page or 2 page in India. It used to be going into 5 pages with the CARO. Maybe now it will come to 3.5 pages or 4 pages, but we still continue to report under CARO. I was of the impression that in 2015, CARO would be gone and completely dispensed with, but CARO fortunately, unfortunately continues currently, and it may continue for a while as well. Now there are other requirements, and friends, I am specifically, this will be sounding very simple and logical, which is true, but many of us may not be adequately following it, and therefore please make sure that you follow, because these are the stringent requirements of the reporting standards. The report is required to be signed in the personal name with the membership number. So in the financial statements of the company, as long as the name of the firm and the partner who is signing is there, that's enough. You are not required to give the membership number of the firm. You are not required to give the membership number of the partner in the financial statements. In the auditor's report, it's very clear that the membership number of the firm and the membership number of the partner also need to be given. In the event that you have reconstituted your partnership firm into an LLP and you have got a new registration number from the ICAI, the new registration number itself is a long number, which is a combination of the old number and the new number as well. So please make sure that whatever ICAI has intimated to you in terms of the firm registration, exactly copy the same. Do not dispense with the old number as well. It will continue to be a part of the new registration number, which is where you need to make a disclosure, and the partnership and the partner membership number also has to be there. The report has to be signed by the individual partner in his own name, clearly mentioning that who has signed the report and including the name of the firm. So Mr. ABC has to sign as ABC, and if he is a part of XYZ firm, he has also to sign XYZ and Co. I am aware that more than 95% of the people are not doing that, but that is basically a requirement. It was also a requirement under AAS 28 that the firm and the partner has to sign in the firm name and the partner name. So that is again a very important requirement. Another thing, please make sure that the date of the report is the date on which you have obtained substantially all the information that would give you a lot of comfort to sign on the audit. Generally, that date is the date on which the financial statements are approved by the board of directors. Now, that's normally the date when the board meeting is held to approve the financial statements. Now, what happens normally, practically, with due respect, a lot of information flows after the audit committee date or after the board date, and the auditor would wait till such information comes in, and then he will sign. But then he will be signing after getting lots of information where he was not able to conclude on the board meeting date on the audit assertions, on the true and fair view, on the state of affairs. That's the reason why it is important to collect everything before the date of the board meeting on which the accounts are to be approved. It may so happen that the board meeting is on the 23rd of March, or let's say 23rd April. You have received some information by 23rd April. Even the financial statements are not properly. I'm talking about some unlisted companies. In the case of listed companies, definitely there is a lot of pressure to provide all the information because there is an audit committee and the board and the independent directors. But please don't do this in the unlisted companies also. There will be a trail of lot of mails between the client and yourself between that 23rd of April and the 5th of May. You are physically signing the report on the 5th of May, but you are putting the date of 23rd April. If tomorrow, and please, the National Financial Reporting Authority also has access to the work papers of audits of companies which are not listed, depending upon the thresholds. If NFRA or any regulatory authority is able to prove it to you that you have obtained adequate evidence after the date of the board meeting, how could you conclude and how could you sign off the report on the date of the board meeting? This is a common practice, and please make sure that you discontinue with this practice, because you have to go and tell your client very clearly that you are subjected to reviews, and if something goes wrong, you will be penalized. So please make it a habit. Otherwise, we go and go back to the clients and tell them very clearly, sorry, we are not able to sign off on 23rd April. We will need more time because this evidence is not obtained. There are fights, there are issues, there are conversations, and they will say, no, if you're not able to do it, we will get another firm to do it. Fine. What does this mean? That the other firm will come after 23rd of April and sign off as of 23rd April. Maybe. They may or may not do it, but I'm just saying. So these are the things, friends, which you have to keep in mind. The trail of audit evidence is something that can be proven against you in the court of law if you happen to sign off much later physically after the date of the board meeting and put on the report the date of the board meeting. So please be very careful on that front. The location has to be the place where you are physically signing the report. So let's say that I have to sign the report today, and today I'm not in Bombay. I'm right now over here, then I'm going to be in Ahmedabad. So depending upon when exactly the report comes to me through a scan copy, I need to put my place of the report as that place. Internationally, in the United States, irrespective of wherever you are, the auditor would put the place as the place where his office is located and not the place where he's physically signing the financial statements. So these are the differences in the two standards. Yeah, so you have to sign. Absolutely. You are required to actually sign off as of today. Sir, can I, in fact you came in later, I just made a request that I have to leave. So I have requested for the questions to be parked at the end. I'll answer your questions. Thank you. Now there are requirements, and I think this is, I will just touch upon this particular requirement only for a minute, because it's not very, very common in India, but it's common otherwise. That you are required to report under the auditing standards issued by the Institute of Chartered Accountants, and you are required to comment on the auditing standards issued by the International Standards of Auditing. Now somebody will ask that, how can I give an opinion, one opinion with two different standards? Now today if you look at it, our auditing standards in India are almost aligned to the international auditing standards. There is hardly any difference between the international audit standards and the Indian audit standards. Yeah, internationally there could be much more standards than what we have today, but they are almost aligned. And that is the reason why even the auditing standards in India are more or less given the same numbers as to what we have internationally. For example, 700, 705 are actually aligned to the international numbers. So now in case if there is a requirement that you need to report on dual gas, generally accepted auditing principles, generally accepted auditing standards, then you have to do that, and you can do that as a part of the audit report, as a part of the same audit report. So it says very clearly that you can do that provided that there is no conflict between the requirements in auditing standards in India and those in the international auditing standards that would lead the auditor to form a different opinion or not to include an emphasis of matter paragraph. So in India you may have an EOM requirement, in the international audit standards you may not have an EOM requirement for a same matter, and vice versa. If that situation exists, then you cannot give two reportings under one report. But if the state of affairs remain the same and under both the standards the reporting exactly remain the same, there is no major reconciliation between the two, then you can go ahead and give that report under two different standards. But as I mentioned, this could be done in very, very extremely rare circumstances. Now that was on the auditing standards. Now let me come on the accounting standards. You have the accounting standards issued by ICAI, and you have accounting standards which are currently IFRS, International Financial Reporting Standards. We have not yet migrated to Ind AS as yet. Now the company may prepare two different financial statements, one completely under IFRS and one under Indian accounting standards. I will say Indian accounting standards and not Ind AS. Ind AS is my Indian IFRS applicable from April 2016. So I will continue saying only Indian accounting standards, what we call as Indian GAAP, generally accepted accounting principles. So therefore, in some cases, your financial statements may require you to have two financial reporting framework, which is my Indian GAAP and IFRS. And this could be a requirement from the management. You can do two reportings in the same audit report. One on the true and fair view on the financial statements of Indian GAAP, and one on the true and fair view of the financial statements prepared under IFRS. Precisely in a similar manner as to what we did under Indian auditing standards. However, you need to make sure that there is no major reconciliation between the numbers as presented under IFRS and under Indian GAAP. That's it. As far as 700 is concerned, these are basically what I have mentioned about the signing and all that. Now this is a very important standard, and I'm coming to 705. This is very, very, very important. So please, I will take maybe 20-25 minutes to go through this particular standard. And therefore, I will make it extremely easy for you to understand under what circumstances you need to give a qualified, you need to give a disclaimer, and you need to give an adverse report. But at the outset, I would like to say that none of these reports are appreciated. Qualified opinion can be tolerated to an extent, and therefore you need to be very sure as to what and how you are qualifying. A disclaimer of opinion is never welcome because the auditor is not even providing a true and fair view. He disclaims from providing a true and fair view. And you can imagine the impact of an adverse opinion. An adverse opinion on a client, an adverse opinion given by an audit firm can come back very heavily on both of them. The moment that there is an adverse opinion, the regulators, the other agencies, the bankers are really going to chase the company and the audit firm. So it is under very extremely rare circumstances that you will be using this weapon given to you. In case if you use it, you need to document it very clearly with adequate consultations and opinions being obtained as to under what circumstances you had to give this opinion. So please make sure that we follow these standards very rigorously. As I mentioned, this is a slide that covers the three different types of opinions. However, whether a qualification or a disclaimer or an adverse report will depend upon the nature of the matter giving rise to the modification. And again, it will all depend upon the judgment of the auditor about the pervasiveness of the effects or possible effects of the matter on the financial statements. I'll come to the meaning of the word pervasiveness. That's not very clearly understood by many, so I'll dwell upon that as well. These audit standard also is actually mandatory from April 2012. So all these standards are there from April 2012 onwards. And even currently there is no major change. In fact, my office actually went through the entire presentation with the new requirements, but I'll tell you exactly where the changes have happened in the audit report, and that is under section 143.3, where you got two additional clauses called 143.3F and 143.3H as a part of additional reporting requirements besides other things that you need to report. Now, under what circumstances would you give a modified opinion? You would give a modified opinion under a particular circumstance where the audit evidence obtained, based on the audit evidence obtained, you conclude that the financial statements are not giving a true and fair view, or as I mentioned earlier, you are unable to obtain appropriate and adequate audit evidence, which leads to you to believe that the financial statements are not free from material statement. That means that under these two circumstances, you will give a modified opinion. Now, this particular definition I would like to read so that you fully understand. What is the meaning of the word pervasive? It is a term that is being used to describe the effects on the financial statements of the misstatements, which means the errors, or the possible effects on the financial statements, if any, that would be undeducted due to inability to obtain sufficient appropriate evidence. In short, it means that if at all you have a reason to believe through the audit evidence, or in case if at all you do not have the audit evidence and you tend to believe that the true and fair view is substantially. May I request everybody to keep it on the silent mode, please? Thank you. If there are reasons to believe that because of these two specific aspects, the financial statements will not be giving a true and fair view at all. In fact, you would not be in a position to even imagine the impact of these potential adjustments that can go through on the financial statements. It means that it is completely pervasive. It is something that you have no imagination, it has no limits, it has no end to it. And therefore, this is something which is very alarming, and therefore it needs to be well understood before you come to a conclusion. Now, under what circumstances would you give a qualified opinion? Again, under two circumstances, you will give a qualified opinion. And a qualified is the, as I mentioned, is the most safest of the three modified opinions. One can live with the qualification. So under what circumstances? You have the audit evidence, and based on the audit evidence, you believe that you have concluded that the financial statements are not free from material misstatement. The moment you believe, you bring it to the management agrees with you, and the management will say, fine, we will go with the adjustment. Once the adjustment is done, there is no need for qualification. But in the event that the management agrees with you and may not want to go with the adjustment, you are required to qualify. In the event that the management does not agree with you, you have no choice but to qualify. But at that point of time, this matter would be escalated to the board or to the audit committee, because the CFO and the MD may not be wanting to agree with you. And that's where you need to qualify, giving the impact of the adjustment on the financial component, on the profits, on the reserves. So it could be a underbooking of sales, overbooking of sales, it could be underbooking of expense, overbooking of expense, anything. That's a qualification. Second circumstance, as I mentioned earlier, you do not have adequate audit evidence, or the auditor, even though unable to obtain sufficient and appropriate evidence, you do not have an evidence, but your gut feel, your other queries and your other inquiries have made you to believe that even if I do not have this evidence with me, there is a material misstatement in the financial statements. Because I do not have something, I have done something else, and I tend to believe that. And under that particular circumstance also, because basically what we call it as a scope limitation. You are not given something, and therefore you are not in a position to comment on. But you have reasons to believe that the impact will not be beyond this amount, or the impact is not that very, very material. It is material, but not that very, very material to be completely pervasive. And under that particular circumstances, you would be giving a qualified opinion. So under these two circumstances, you would give a qualified opinion. Now I'm coming to the most important one, and that is the adverse opinion. I'm not taking disclaimer right now, because then I'll make you understand what exactly is a disclaimer. So we spoke about qualified. I'm coming to the adverse opinion. Very simple. As an auditor, I have got all the sufficient appropriate audit evidence with me. I'm happy with all the evidence obtained. There are certain things that should have been accounted for in the books of account, in the financial statements. They are not there. I'm checking up with the management, they said nahi karna hai. So the impact is material. But not only the impact is material, but the impact is so much that it can be anything and everything. It can be completely pervasive. It can be unlimited. It can even change the reported profits that have been given to you into a loss. And that is the reason why you tend to believe that the financial statements do not give a true and fair view of the balance sheet, state of affairs, of the P&L account, the result of your operations. Is that impact measurable? May not be. If it was measurable, you would have qualified it. But it is not measurable. It can be beyond your thinking. It could be any potential outcome of a litigation where you do not, and you know for sure that the company is actually in a bad state. It could be a major potential impact of a going concern. It could be anything. And therefore it is material and pervasive. And you conclude based on the audit evidence that it is material and pervasive. That is the time that you would be using this weapon called adverse opinion. We've done that in one case and we know the repercussions of that. First of all, though, you have to leave the job as an auditor. And I'll come to that also as to why should we continuing doing the audit of that company after giving an adverse opinion. Now I'm coming to that later, but look at the disclaimer. This is something in between the qualified and the adverse opinion. We've understood the qualified, we've understood the adverse. Disclaimer thing starts with the fact that you do not have sufficient appropriate audit evidence. So when it says it's unable to obtain sufficient appropriate audit evidence on which to base the opinion, and the auditor concludes that the possible effects on the financial statements of undetected misstatements could be both material and pervasive. Now this is exactly very similar to adverse. Only in the case of adverse you had all the reasons to believe based on the audit evidence. In the case of disclaimer, you do not have sufficient appropriate audit evidence, but you believe that the misstatement is not only material but is also pervasive. This is your gut feel. And when you have a gut feel, when you are 99% sure but not 100%, when you do not have enough information obtained from the client to conclude, that's the time you are not in a position to give an opinion. And that's the time that you would disclaim the opinion. So under these circumstances, you are required to give a disclaimer of opinion. In case if at all there is any, because of the shortage of time, otherwise I was going to make it a little more humorous. You could see this particular picture of a gun, and I'm just on a lighter note, it says that if you start doing this, then the regulator and the client is going to show you a gun and start coming and shooting you. So today whatever I'm talking is there as a part of the auditing standards. I'm required to cover that. You may be thinking that why should we give a disclaimer, why should we give an adverse? But trends have started. You will be seeing, and you are already seeing, many auditors resigning from the companies. Before even you can give a disclaimer of opinion, you need to find out an opportunity as to whether you would want to resign. In many cases where you are appointed by the CAG, you may not be able to, or under the regulator's statute, it may not be possible for you to come out because you cannot resign from that particular audit. So in that particular case, whenever the circumstances prohibit you or preclude you from resigning from the audit, you will be required to give an opinion. So give a disclaimer or give an adverse or whatever. But the first thing that I would do as an auditor is that whenever I believe that I am not in a position to give a clean opinion or a qualified opinion, but I have to give an adverse opinion or I have to give a disclaimer of opinion, then I would be resigning from the audit. That's my first step. Second would be to think about what needs to be done next. Now remember friends, that the moment you resign from an audit, you are not only required to give the reason to the incoming auditor of your resignation because you are going to give a no objection certificate, but you are also going to be giving the reason of your resignation to the central government because you will be intimating the central government as well that you have resigned from the audit. Even if you do not do a good job and the company would want to throw you out, even the management will have the right to break that term of 5 years of appointment, do not reappoint you or whatever, and inform the management, and the management will inform the central government that it is for this reason that we would like to appoint another auditor for the intervening period or whatever. So the very first thing is that please make sure that we follow the process of whatever is required to be done. In case if you become aware after accepting the audit of any imposed limitation on the scope of the audit, for example, the management may not want to share some information with you for whatever reason. I get calls from my clients that can you please come over, we would not like to share the payroll of our employees or some of the key employees. Well, I tell them that nowadays even the managing director's remuneration and the board of directors remuneration is actually there in the financial statements. What is there not to share? Everybody knows exactly what's happening. No, we would not want to show the payments made to some of our sales executives and all that. Now, that is a different thing that they may not want to share down the line, but many a times the client does not want to share some of the information. And if you believe that that information is important and relevant for the finalization of the audit, then I suggest that you go and get that information. In case if you believe that you do not have sufficient information, as a result of which you cannot conclude on the audit, then you better think of resigning. The first thing that you would do is, any issue you need to communicate with those charged with governance. This is a new term, those charged with governance, which means the audit committee and the board. Where you have an audit committee, your responsibilities to the audit committee. Where there is no audit committee, responsibilities to the board. Even the board has independent directors and therefore they are charged with governance, and you need to intimate that you do not have enough information. Same thing, I did speak on the same thing. Even in the audit report, you need to, in case if at all you are giving any qualified opinion or adverse opinion or disclaimer of opinion, before the opinion paragraph, you need to explain the matter very clearly as to why the report is modified. Having explained that particular matter, you then come to the conclusion paragraph of the opinion, and you give an opinion saying that based upon the comments that I have given in the above paragraph, the financial statements, subject to the above, the financial statements give a true and fair view. So, in short, the matter to be qualified or the matter which is modified is there above the opinion paragraph, and subsequent to the opinion paragraph, if there is any other matter that needs to be reported, it then has to be reported. Sorry. So just to capture of what I mentioned, and I would just spend a minute on this so that again it becomes very clear. If the financial statements are materially misstated, you go with me, exactly try to look at the screen along with me. I'm on the left hand side. If the financial statements are materially misstated and you have obtained all the information that is required to, and you believe that the adjustment has to go through, and if the adjustment has not gone through, then you have to give a simple qualification based upon the standard. So you will give a qualified opinion. The impact is material but not pervasive, which is fine, and therefore you'll give a qualified opinion. Financial statements are materially misstated, so they are material. Not that they are material also, but they are also pervasive. And you have obtained all the evidence. So you have all the evidence, you believe that based on the evidence it is material, and so much so that it is pervasive, it completely changes the profit loss, everything. In that case, you will be giving a adverse opinion. I'm coming below. When you do not have sufficient appropriate audit evidence to conclude, and you believe that the impact is material but not pervasive, which means that yes, it is material but it cannot be completely misleading, you will only give a qualified opinion. And where you do not have enough information, you believe that it is material and you believe it is pervasive, at that point of time you will be giving a disclaimer of opinion. So if you remember this matrix, this should be more than enough for you to conclude the circumstances under which kind of a modified opinion you would be need to giving. Now, material misstatement. A material misstatement doesn't mean that it only relates to recognition and measurement principles of accounting. For example, in case if the financial statements do not completely give the details that are required to be given for related party transactions under the standard, you are conceding a lot of information out there, and therefore they can be called as material misstatements. Now, under what circumstances would the financial statements be misleading or materially misstated? In case if the appropriateness of the accounting policies is a question. You have the accounting policies, but are they appropriate? Have they been selected properly? Number one. Number two, application of the accounting policies, whether they have been consistent, whether they have been consistently applied, and the appropriateness and the adequacy of the disclosures. So anything to do with the recognition and measurement, anything to do with the application and consistency of the accounting policies, and anything to do with the appropriate disclosures of financial statements. If the things are missing out there, then you will be required to, then it is concluded that they are materially misstated. We come to the next standard. So 700 was opinion on financial statements, 705 is modified opinion on the financial statements, and 706 is the one which is emphasis on matter. If you look at the heading of this particular standard, it says you need to emphasize a particular matter. So it infers the fact that this matter is somewhere there in the financial statements, and that is correct. Whenever there is a particular matter to be emphasized on for better understanding of the financial statements, to enhance the transparency process in the financial statements, you need to take a view. But people, as I mentioned earlier, were doing anything and everything. Even when not required, they were emphasizing. Where required, they were not emphasizing. And that is why the standard was given to say very clearly under what circumstances you would be emphasizing on a particular matter. Again, this standard is actually applicable from 1st of April 2012. So 700, 705, 706 are all applicable from 1st April 2012. Prior to emphasizing on a particular matter, as an auditor, what you need to do is that you need to be very sure that this matter that you are emphasizing is not the one that you would have otherwise qualified or would have disclaimed. So over here, I would like to only stress upon the fact that the moment there is a particular matter, first of all evaluate whether it is a potential qualification or a potential comment. If it is a potential qualification, you cannot emphasize on it. Clients will actually, they are very smart. Clients will actually force you to review a qualification as a para of emphasis. Even where it is a para of emphasis, they will tell you not to disclose. Or many a times the challenge is that even that particular note will not be disclosed in the notes to accounts. So where you believe, based on your judgment, based on your skepticism, and these days I am not scaring that take a conservative call all the time, but under the current circumstances, please take a call based upon proper audit consultations and proper review of things to be very sure what is a qualification, what is a para of emphasis, and what can be just a note in the notes to accounts. So first of all, you should be sure that it's not a qualification. Then where does this para come in the audit report? As I mentioned earlier, it is after the opinion paragraph, because this is not an important matter. It is a matter that you need to be aware of and you need to be informing the readers of the financial statements, and therefore it comes after the opinion paragraph under something called other matters. So the heading of that particular paragraph could be emphasis of matter or other matters. You need to make a reference in that particular paragraph of the note which is there in the notes to accounts, that with reference to note number 20 or note number 25, okay, we would like to draw your attention, blah blah blah. And finally, don't stop there. Many of us stop there. If it is a para of emphasis and if it is presented in the audit report, the institute has clarified, saying very clearly that you need to add one more line, and that one more line says that the auditor's opinion is not modified in respect of the matter emphasized. So it very clearly says in the audit report that this is not qualified nor disclaimed. I had a recent interaction with a client where he was happy by me allowing me to sort of, give a disclosure on para of emphasis and say that fine, you can report, but don't write that this is not qualified. I said, this is in your own interest. First of all, it's a statute. I have to report because it says very clearly in the standard that the above matter is not qualified. If I will not report, it's my mistake. And what is wrong in reporting that this matter is not qualified? No, I don't want the word qualification in the audit report. I said, I'm writing very clearly over here that this matter is not qualified. It took me almost a couple of hours to convince him. I said, it is in your own interest that the auditor is saying very clearly that the auditor's opinion is not modified. So then he was agreeing. I had to show him the standard and everything, and then he agreed. So please make sure that this additional line that you have not qualified or you have not modified the audit report exists in the last paragraph. Now, under what circumstances? Now, these are not exhaustive. These are a couple of examples or 2 or 3 examples. Under what circumstances would you be providing an emphasis of matter? There can be an exceptional litigation or there can be a continuous litigation, and you would not be sure about the impact. Now let's say that there is a court case going on against the company filed by its employees, and there is a belief that it could result into a material impact on the company. You are not too sure what it could be. The decision is not taken today. The decision will be taken at some point of time. So there is a potential liability on the company. It is a contingent liability. The potential liability is on the company in the future, and therefore you would not know. Now this could be 100 crore, 200 crore, 500 crore, 1000 crore, depending upon the volume and the size or whatever. There will be a note in the notes to accounts, but as an auditor you believe that you would like to bring attention of the readers of the financial statements, because the potential impact of that particular liability in the future can cause an impact on the going concern of the company, and therefore you need to make a reference on that. Secondly, whenever there is a new accounting standard and the application of the accounting standard is before the actual date of application, so let's say if the accounting standard is applicable from 1st April 2017 and you want to apply the accounting standard 1 year early or 2 years early or whatever, somebody should know that you have applied that accounting standard because it is an early application. Your recognition and measurement is based on that particular early application, and therefore your financial statements which are giving a true and fair view are based on the accounting policy carved out of the early application of the accounting standard. And therefore you need to make a reference very clearly. If you look at the IFRS financial statements, it says very clearly internationally that which accounting standards have been early applied, which have not been applied. Similarly over here, but that is a part of the financial statements. Here it is a part of the audit report that you need to emphasize on a standard where there is an early application. Another example could be a major catastrophe has occurred, and based on the major catastrophe there is already a damage done, and the damage could continuously impact the future profits of the company. Now you would not know to what extent, and therefore you need to emphasize on that matter as well. There is one myth about going concern, and this is something that I have seen. There is an accounting standard there is an auditing standard, on going concern. It says very clearly under what circumstances would you be qualifying, or would you be disclaiming, or would you be giving an adverse opinion, or would you be giving a para of emphasis, or you would not be doing anything in the audit report when it relates to going concern. I have always seen that the professionals want to play safe, and there is nothing wrong by emphasizing on the going concern of the company. You need to do that only when you tend to believe that the information is not so much available with you to conclude as to whether the company would continue to be a going concern. You would qualify a going concern where you tend to believe that the mitigating plans on going concern are not adequate enough for the company to continue as a going concern, and you would qualify that. But in case if at all there are mitigating plans in place, they are adequately explained, you are fine with the audit evidence, and there is a complete disclosure in the notes to accounts about the ability of the management and the promoters to pump in capital for the company to continue as a going concern, and you need to review going concern only 1 year later, which means that if I am reporting as of 31st March 2015, for me to comment on the going concern, I need to make sure that whether the company has the ability to continue as a going concern till 31st March 2016. If I have all the reasons to believe, all the evidence to believe, and if there is a disclosure in the notes to accounts, you are not required to emphasize on that. It says very clearly. However, I have seen that people want to play safe and they still make a disclosure in the audit report by giving a para of emphasis on that. So that is something I just thought that you should be aware of. On the audit front, I can only tell you one thing, that please make sure, it is again, I'm saying from experience, that the draft of the audit report, including your CARO, needs to be given to the management well in advance, needs to be shared along with the board papers, because many a times the audit committee members are saying, I have not got the draft of the audit report. Where is your audit report? How would I know whether it's qualified or not? So it creates a lot of problems. So please make sure that when you are giving a clearance on the financial statements and it's forming part of the board pack, also give a draft. Very clearly mention the word draft, very clearly, so that people know that it's a draft. Because suppose in case if at all you need to change something in the future, they should not say that this is a final report on that front. So please make sure that the draft report goes along with the board papers. On this particular standard, I would not like to dwell much upon it. It's a new standard. It's a very, very simple standard. It talks about the responsibility of the auditor in relation to other information forming part of audited financial statements. Now, my audited financial statements, along with the audit report, form part of my annual report. Within the annual report, I have got director's report, I have got MD&A, I have got analysis, I have got a lot of other information. Internationally, if you see over the last so many years, the auditors would get such information besides financial statements from the management before signing the audit report. The idea is to observe inconsistencies between such information and the audited financial statements. Inconsistencies can be of two types. One would be where there can be mistakes in the audited financial statements and the numbers coming in the MD&A or in the director's report or in the analysis could be fairly correct. Other way, there could be mistakes in the MD&A, in the director's report, and not in the audited financial statements. As an auditor, I would tend to believe, and this is on the lighter note, that the audited numbers would be 95% correct numbers. And therefore, there can be mistakes because we would have changed the numbers during the course of the audit, the management would not be aware, and the MD&A and the director's report may be having mistakes. Now it is a duty of the auditor to ensure that this information that is provided to you is also reviewed by you, and if at all there are inconsistencies, then they need to be addressed, they need to be plugged in, so that the information in the director's report and in the audited financial statements is consistent, reliable, and assured. Now that is a duty of the auditor. 90% of the time, I am saying 90% of the time because it allows you, and therefore 90% of the time you must insist on having that particular information with you before you sign off the financial statements. Because in case if at all something is wrong in the financial statements but rightly shown in the other information, it will give you a heads up to correct that information in the audited financial statements. And therefore it requires you to give a comfort on that information before the board meeting date. But many a times some information will not come to you because the board report is still not ready, the MD&A is still not ready, the printer will, it will go for printing maybe a month or two down the line. In that case, although you would have audited and signed off your financial statements, please make sure that you insist on getting all that information before it goes for printing. Because once it goes for printing, you will not be in a position to ask for that information and change again. So before it goes for printing, please make sure that you have reviewed all that information and inconsistencies, if any, have been addressed. So I think this is what we have in terms of audit reports. We covered clean opinion, we covered modified opinion, we covered emphasis of opinion, and we covered responsibility of the auditors in terms of other information in the financial statements. A couple of other things I thought, I just worked on it this morning. I thought it is very important. I touched upon, before some of you came over here, I touched upon very briefly on internal control over financial reporting and the requirement of the auditors to attest for 31st March 2016. I covered fraud reporting, where it is a duty of the auditor. It is just to sort of, refresh people who have just who walked in a little late. I also touched upon the fact that it is a responsibility of the auditor that in case if at all he has discovered a fraud committed by an employee or an officer of the company on the company, and if the auditor has discovered the fraud, then it is a responsibility of the auditor to intimate that fraud to the audit committee or to those charged with governance or to the board of directors. And the board and the audit committee and everybody should come back to the auditors within a period of 45 days. Within a period of 45 days from the date of communication to the auditor, date of communication by the auditor. So I would report to the board on 1st January, and by 14th of February the board should come back to me, and I said 45 days, which means that 14th January. You have to calculate exactly 45 days. So 14th February, sorry. By 14th February, the board has to come back to me and say that this is the action that they have taken. These are the adjustments going in the financial statements. and this is the total amount of loss being absorbed by the company. After receiving that information, the auditor is required to report to the central government within a period of 15 days from the date of receipt of that communication. Now, just a couple of things over there. First of all, please remember that this is the fraud detected or discovered by you and not by the company management. In the event that the company management has actually found a fraud, they will follow their own process, they will do their investigation. You as an auditor would know exactly what are the results of the investigation. Just in case, if the management is not initiating the investigation or has not incorporated the adjustments arising out of the fraud, after having given reasonable time to them, and I say 3 times, given them adequate time, don't lie low. If the management has not done that, after giving them enough opportunities, it is now your responsibility to report that fraud, although that particular fraud was not detected or discovered by you. This is very clearly given in the guidance note. First thing. Second thing, let's say that you have detected a fraud, and once again the audit committee has not responded within 45 days, has not responded within the given number of days. You will give them 5 days more, 55 days are over, and they have not come back to you. You need to report to the central government that you have escalated this matter. 55 days ho gaya, maybe they need more time, whatever. Then it is up to the discretion of the central government as to whether they would want to give more time to the company or they would like to impose penal implications on the company. But as an auditor, it is your duty to bring it to the attention, the fraud, and the form that requires to be filled up is ADT4. So we touched upon that as well. That's not forming part of my agenda for today, but somebody had requested this morning that I should touch upon it a little bit, and that's the reason why I clarified on that front. Now I'm just coming very quickly to a very important I'm not saying thank you at the moment. I have about 20 minutes and I think I can do some fair justice on that. So this is actually on audit reports, and these are not the standards, but these are the new audit reports which are required to be signed off for 31st March 2015 year end. And the duties and the powers of the auditors are covered under 143.1. Now friends, including me, we all have a challenge to learn the new sections. Today even also when I think about Companies Act, I still have in mind the old section of Companies Act 1956. So we also need to be completely aware, and we have to come up to speed, because it's not just the Companies Act. We are going to have Ind AS, we are going to have GST, we are going to have a lot of changes coming up, and already we have a lot of other things in internal control over financial reporting and all. So this is again an exam time where some of us who are cross 50% of our life will have to study again, not go back to college or give any exam, but we need to study again and come back to speed also. So under 43.1 it says you need to make an inquiry, you need to prepare a report to the members. There are other matters to be reported in the auditor's report, which is fine, which is all there. We also know that these are the matters to be reported. I touched upon the modification in the report, which I have done earlier already, so nothing to do about that. Then, this is one matter, which is a new matter that has come in the auditor's report. And so therefore, please make sure that you report on this matter as well. It says that, are there any observations or comments on the financial statements or matters which have any adverse effect on the functioning of the company? This responsibility is casted upon the auditors to report on adverse effects on the functioning of the company. So now you need to report that as well, and that is a part of 143.3F. Under 143.3H, again there is a separate requirement to report any qualification or reservation or adverse remark that you would have relating to the maintenance of account and other matters connected therewith, which means that all your books of account, which include income expenditure statement, receipts and payments, balance sheet, etc., If at all there is any qualification or any concern there, then you need to report on these things. So these are the two additional matters that have come in as a part of your reporting requirement. Now I will just touch upon only for a minute on CARO, just for a minute on CARO. It's not a part of my agenda, but as I mentioned earlier, CARO is not applicable to many organizations. The very fact that it says companies auditors report order, it will have applicability on some companies and it will not have applicability on other companies. Banks are companies which are limited companies which are registered under the Companies Act, but yet CARO is not applicable to them because your reporting requirements are in accordance with the RBI regulations. Insurance company, again the reporting requirements are in accordance with the IRDO regulations. Similarly, non-profit companies, etc. Even a one-person company is exempt from CARO because of the smallness of the size of the company. And again, private limited companies are exempt if at all they fulfill all these conditions which are there. If the paid up capital and reserves is not more than 50 lakhs, it does not have any outstanding loans at any point of time during the year exceeding 25 lakhs, or it does not have its top line exceeding 5 crores. Couple of questions came to me during my earlier presentations as to whether these are cumulative or alternative. If you look at it, it says and. So they need to be, even if one by chance exceeds, then you will be having to report. Over here, there was one more clarification which I gave earlier, whether a CARO is applicable to a liaison office or a representative office in India. CARO will be applicable. So it is applicable to a rep office, it is applicable to a branch office, it is applicable to a liaison office. There is no ambiguity out there. People have got different thoughts, but there is no ambiguity out there. CARO is applicable on these three entities as well. Now, what are the new things under CARO? The good news is that from the 21 clauses that we had to report, the first one being on the fixed assets and the last one being on fraud, that 21 has now become 12. So the good news is that yes, the clauses have deleted from 21 to 12. It's not applicable to one-person companies and small companies, and therefore I think it is made much more simpler. The most important thing that you need to look into is just look at the last bullet. Under that particular statutory dues, VAT is covered. So please do not forget to report non-compliances or delays in terms of deposit of VAT from now onwards. It is applicable to you because this particular requirement came from 10th of April 2015. There are two schools of thought. One school of thought says very clearly that it is yet to be published in the official gazette and therefore CARO 2015 is not applicable. I think that's completely wrong. That is only a technical interpretation and a technical formality. CARO has been notified and it's forming the part of the land, and whatever audit reports you have been issuing after the 10th of April, CARO 2015 is applicable from that particular day onwards. So these are the changes. I think I don't want to dwell a little more on that because clauses have remained the same. Some clauses have gone, some clauses have not gone. I believe the good thing that they have done is that a lot of information is now required to be reported. For example, the impact of the litigation in case whether the company has provided for litigation is forming part of the audit report, number one. In case if the auditor believes that there can be foreseeable losses in the future of the contracts which are in existence, then the company needs to provide on the principles of conservatism those foreseeable losses. If that is not done, then again again in the audit report you are required to make that particular mention. These are all the clauses which are there or which are not there. Unfortunately, the requirement of reporting on the internal audit, because earlier we were reporting whether the internal audit of the company is commensurate with the size of the company and the nature of the business. That requirement is gone. It doesn't mean that the internal audit requirement is gone. In fact, they have made it much more stringent, making it applicable to a larger number of companies than what they were before under the Companies Act. And therefore, although the reporting on internal audit is not there, the fact that internal audit function is going to gain more momentum is not a doubt at all. And the fact that the internal controls over financial reporting would be required to be reported by the statutory auditor next year is a measure that is being geared up on the controls. Now coming to the last one, very quickly, I just made it this morning. That's why you see no colors and no shades out there. But Can all of you read it? Okay, great. Otherwise, I'll make it very simple in terms of making you understand. Consolidation of accounts, I think it's a step in a very good direction. All along, only the listed companies were required to consolidate the financial statements. That was not coming from part of the Companies Act. It was coming as a matter of requirement of the listing agreement with the stock exchanges. We were guided by Accounting Standard 21, supported by 23, 27 in terms of what needs to be consolidated. How subsidiaries are consolidated, how investments in joint ventures, investment in associates need to be accounted for, all that we are aware of. Now the world is changing and we are also aligning ourselves with the best practices, and therefore the distinction between a listed company and a non-listed company is gone. Consolidation of accounts is mandatory for all the companies in India in case if they have a subsidiary or in case if they have a associate or a joint venture. Of course, there are clarifications which have come in and we will talk about that as well. If you look at the third bullet, it says that where a company has one or more subsidiaries, it shall prepare CFS, consolidated financial statements, of the parent company and the subsidiaries, the joint ventures and the associates. If you recollect earlier, we were not consolidating joint ventures and we were not consolidating the associates. We were doing only for subsidiaries. Even for subsidiaries, there was a disconnect. We were considering subsidiaries only where there was a 50% plus shareholding. But friends, you are also required to consider, even under the old Companies Act, in case the control and the composition of the board of directors of the subsidiary vests with the holding company. If the holding company has the power to control the composition of the board of directors, irrespective of the shareholding of the holding company in the subsidiary will still be required to be consolidated. It's not by voting power, it's by control and influence. And that needs to be considered. That is equally aligned with the IFRS as well. Unfortunately, we were missing out on that front because I could see some of my clients doing that in the past. And therefore, it's important that we understand this very clearly. Now you only have subsidiaries, both of course, voting power and control, and joint ventures and associates to be a part of my CFS. However, provisions of Schedule 3 of the Companies Act, where it relates to the preparation and the form and content of the financial statements, that will prevail, and that will give the guidance of preparing the financial statement, which are consolidated financial statements. However, you need to follow AS 21, read with AS 23 and AS 27. What is the challenge? Today, the challenge is that yes, we may be having information on the subsidiaries, but would you have timely and reliable information on joint ventures and associates? Many unlisted companies also declare the results by 31st May, 30th June, not under the statute, but for their own purposes. As an auditor or even for the management, the challenge is that they should be having appropriate, adequate and relevant and reliable information of these companies other than subsidiaries and including international subsidiaries from a consolidation perspective. I'm coming to some of the announcements made by the government later, but today the challenge is that you need to have all the information to do an effective role on the consolidation. Now, when you have a holding company in India, you may be having subsidiaries in India, you may be having international subsidiaries under different jurisdictions, and you will be having JVs and associate companies. It's a clear fundamental rule that when you are consolidating, the accounting policies should be aligned with the parent company. So the accounting policies of all the subsidiaries and the joint venture should be aligned. You also need to make sure that the GAAP or the generally accepted accounting principles should be Indian GAAP while consolidating everything. So if you have 5 subsidiaries in the US, 5 in the UK, 10 in Australia, and all the world over, and you look at Infosys, look at TCS, look at Wipro, and some of the companies even in the engineering sector or in the manufacturing sector, you have Tata Motors, you have 1,000 international subsidiaries out there. What do? First of all, to do an effective consolidation and to have a fair presentation framework with applicable accounting policies being consistent, in accordance with Indian GAAP, you need to convert from the local GAAP reporting into Indian GAAP reporting. So all of these need to be converted under Indian GAAP, number one. You need to have consistent accounting policies, number two, and then you need to consolidate. Now I'm talking more from a unlisted company perspective. We all know what needs to be done in the case of listed companies. The clarification over here, the emphasis over here is more on the unlisted companies. So you are required now to make sure that you have all the information with you, converted under Indian GAAP with consistent and uniform application of accounting policies to do an effective consolidation. However, it says that the Ministry of Corporate Affairs recently issued a couple of amendments to the company's rules 2014 to provide that the present preparation of financial statements shall not be required, or CFS, consolidated financial statements, will not be required by an intermediate wholly owned subsidiary. Let's stop here. So if I have a company which is an unlisted company and there is a subsidiary and then there is another subsidiary coming below down the line, you are not required to prepare a CFS for the intermediate subsidiary. Let's stop here. Now read further. Other than a wholly owned subsidiary whose immediate parent is a company incorporated outside India. So now immediate parent of a wholly owned subsidiary company, if it is outside India, then you need to do that particular consolidation for that wholly owned subsidiary. So the exemption is given only if there is a intermediary subsidiary whose parent is in India. But if the intermediary subsidiary, a wholly owned intermediary subsidiary whose parent is outside India, exemption is not available. You will be required to do a consolidation at that time, because of the fact that this is the first company in India where the consolidation will start. That company's parent is in America or in the UK. That would not matter to us. But for me, this is the first level of consolidation that has to start. However, if the parent is in India, and if there is a subsidiary over here, and if there is a subsidiary over here, then this particular subsidiary, the intermediary subsidiary, will not be required to prepare consolidated financial statements. So that is a clarification which has been given. There is another exemption, and it says that a company which does not have a subsidiary or subsidiaries but has one or more associate companies or joint ventures or both. So just in case, if at all you have a parent, you do not have a subsidiary, but you have associates and joint ventures, either associates or joint ventures or a combination of both, and you have no subsidiary, then you need not do the consolidation only for 2014-15. But I would encourage you, if not now, at least 3 or 4 months down the line, that at least start doing the consolidation of that. You know why? Because next year you will be required to give the comparative information on that front. So friends, in case in India, for an unlisted company, if there are no subsidiaries, but you have associates or joint ventures, you have only 1 year of temporary relief for 2014-15. For 15-16, even if you would not have a subsidiary, but associates and joint ventures, you would still be required to consolidate the parent company and the associates and joint ventures. Look at the third bullet. The first two talks about whatever I have discussed earlier. Look at the third bullet. Apparently, it seems that all unlisted companies with a foreign subsidiary are exempt from preparing financial statements for the financial year 2014-15. Now, what happens over here? Just in case a company, now this is a matter of interpretation, how you interpret. The exemption was given also to a company from a consolidation perspective in case if the company has got only international subsidiaries. So let's say I am a company and I have only international subsidiaries, then I would be exempt from preparing the consolidated financial statements for the year 2014-15. Now whether it applies to a company as well who has Indian subsidiaries and international subsidiaries. That's a question. So the amendment says that in case if you have international subsidiaries, you are exempt for 2014-15. It does not say that you would be exempt only if you have international subsidiaries and not Indian subsidiaries. It does not say that. The inference that I would draw is that only if at all you have international subsidiaries and not Indian subsidiaries, then you will be exempt for a year or so. In case even if you would have one Indian subsidiaries and other international subsidiaries, then you will be required to do the consolidation.
So consideration of the Indian subsidiary is required in that case. Say I am having 3 foreign subsidiaries and 2 Indian subsidiaries. So foreign subsidiaries consideration is exempted. What about the Indian subsidiaries? Have to be consolidated?
So let me just finish, sir. I'll just come to your question. I just have got one more slide. As I mentioned earlier, you will be required to follow Schedule 3 of the Act, read with the applicable accounting standards. Now, if you look at it, it does not envisage, that I said, it does not envisage that while a company, while preparing its CFS, merely repeats the disclosures made. It means that in case, if at all, there are disclosures already given in the audited financial statements of the parent company or of the holding company, whatever is required to be given under the consolidated financial statements, fine, you did not repeat all the disclosures out there. So again, there is a clarification to that extent. Now coming to the subsidiaries, as I mentioned, the belief is that in case if at all you have only international subsidiaries of the holding company, to answer your question very specifically, you will be exempt for a period of 1 year. But in the event that you have a combination of subsidiaries in India and subsidiaries internationally, then this particular requirement of consolidation would be applicable even for 2014-15. So I think this is all what I had in terms of the presentation, in terms of all the requirements that are required to be there. Maybe we can have 5 minutes of question answer. CARO deletion, sir? So CARO actually, okay, if you want to go to the deletions.
Sir, excuse me, about your clarification. That, in other words, that means that we have to consolidate for Indian and foreign subsidiaries both in this year, 2014-15.
2014-15, yes, you will have to do, yes.
Both in respect of Indian and foreign subsidiaries.
Yes, if you have a combination of subsidiaries which is Indian and international, you will have to do. If you have only international subsidiaries, then you would not be for 2014-15.
If there is a nomination, then I have to do for both.
Yes, of course, for both, yes. Because otherwise, how will it represent the strength of the group? If you do the consolidation of only the India companies and not the subsidiary and not the international companies, it will not give you the position, the statement of affairs and the financial results of the group as a whole.
Hello. Hello.
Sorry?
Sir.
Yeah, sorry.
Hello.
Yes, please. Somebody's question? Yes, please.
Actually, in one of my companies having a subsidiary in China, the year ending is 31st of December, whereas we are having the year ending as 31st of March. How do I consolidate the bills? Because the audit report is done for the year ending 31st of December there.
In which case, it's a very simple approach. You need to make sure that are the financial results for 31st of December significantly vary from 31st of March. If that is the case, then of course you need to draw the financial statements for that particular subsidiary for 31st of March, although it could be not audited, and consolidate those
can
numbers.
rely on the non-audited figures also.
Yeah, but generally
for the purpose of consolidation.
Yeah, so generally for the purposes of consolidation, the company will have to prepare the financial statements for 31st of March. It doesn't matter that they have been audited or not for 31st of March. In China, there may or may not be a requirement to audit otherwise also. So if at all you believe that the financial position and the results of the operations change significantly between 31st December and 31st March, you need to tell them to prepare the financial statements until 31st of March and then consolidate with the holding company.
Okay, thank you, sir.
Yeah, so under CARO, sir, if I can say that there are hardly any certain clauses have got deleted. Okay. And therefore, I would not want to get into that because that was not forming part of the agenda, what is required, but I can hand over the presentation. Yeah. Surely. I think we have done, and as I mentioned earlier, I would like to be excused because I have a flight to catch. We had a couple of hours of good interactive session. I really appreciate pin drop silence in the room throughout a couple of hours, and I thank you all for a very patient listening and wish you all the best.